Hey, Bernardo, Wealth Extended Family. Want to talk today about money market rates and kind of what we've seen in the past couple years versus what I think is on the horizon and how that really fits in. So think of money market rates, right? We've got like bank sweep, which if you have a checking account or savings account not in a purchased money market, those rates still are very, very low. Purchased money markets have been a nice place to go for the last year or two with kind of your reserve cash. Rates have been high as we've seen the Fed increase rates over the last 18 months or so. We've seen those rates get higher and higher. And right now they're north of about 5%, depending on what money market you're really buying into. Well, now we're coming out of the other side of the cycle. We're starting to see kind of the Fed's mandate of inflation come closer and closer in line with what they want. And the expectation of Wall Street right now is that next week we would see the Fed lower by 25 basis points or 1/4%. What does that mean for our money market that's a little over 5? We should expect that to come lower in lockstep with Fed fund rates going lower. So therefore, if we were at 5 in our money market and the Fed lowers by 1/4, we should effectively see our money market rate drop to 4.75 or right in that ballpark almost immediately once the Fed makes that decision, and more of that potentially to come. So here's some of our perspective. The first thing is that there is still a place for money market, right? But the place for money market is like standby emergency fund liquidity. We think that if you have the money in the checking account that's being fed with income, plus a kind of money market type savings right behind there, if we can account for, let's say, about 3 to 6 months, maybe a year if there's other circumstances, worth of our expenses covered in those two account types, that any amount over that, we should really be thinking about investing for a longer term horizon. In my experience, what I tend to see too is we end up replenishing more and more money through income and investments, etc. So cash continues to pile, and we're not as disciplined to get that over and say, hey, longer term money, we've got what we need short term, so let's try to do better than just money market rates. So that's something I want to kind of provoke the thinking, especially as we think that money market returns are going to lower. And how do we get ahead of that? So I think that's a conversation's a good one to have. Let's make sure our liquidity is right, our standby kind of emergency fund capital, our stability right behind there in money markets. And then if we've got a surplus, let's think about how we could put that to work to hopefully do better over time, knowing short term we're in a good situation. So those are my thoughts. I hope this was helpful. Should talk to your advisor about, if that's your situation, let's revisit it. We're constantly looking at that here, and we'll bring that advice. Obviously, if you have cash in other places, it's always good to make sure, we're on the same page. So I hope this was helpful. Thank you, and we'll talk to you soon.